Over half of my portfolio is Tesla, and I'm so glad it went down today. Hey everyone, welcome back to another video. And today I'm going to talk about my Tesla option plays. So I like to do something called short strangles, where I am selling a put and selling a call far out of the money to receive premium. And then as long as the price of Tesla stays within a certain range, then I make money from data decay. Now, what happened in the past few days was, for the call portion of my strangle, I sold a couple of covered calls around October 6th, right about here. October 6th, the price of Tesla was $415. Yesterday, Tesla shot up again. It's up $40, which is roughly 10% up. Now, what that means, and I'm just going to focus on the covered call portion of a strangle, it's that when I sell a call, I'm giving somebody else the option to buy 100 of my shares at a certain price. They want the option to buy Tesla shares at a cheaper price because they are afraid of the price going up. The contract they are buying from me increases in value if Tesla were to increase in value. So this is my TD Ameritrade account. If you see here, this 600 call, these two Tesla calls at a 600 strike price, I sold these on the same date, October 6th. And right now, today's date is October 15th. It's been 9 days, basically, over a week. And here is the current value of these two contracts. They are still in the negative. Had Tesla stayed around the same price, I would have had gain already. And this gain is unrealized. So what this means is I sold this contract at $6.80 per share, or $680. But the current value of this contract is $692. So if I were to close this position out, I would have to buy the contract back to close it out. If I were to buy it out, I'd be doing it at a loss because I sold it for less than it's worth now. I have to pay more to buy it back. And same with this call here. I sold it at $900 total, but right now its current value is, it came back up. So as I was recording, the value of this call dropped a little bit, and now I'm in the money again. But like I said, it's been over a week, and this is roughly break even. That's not good if I was just selling covered calls, because I want to be able to make more premium on these covered calls. The reason this has ticked back up is because the share price itself continues to drop today. And as it drops, the value of the current call is going to be lower. Today is actually looking really good again, but yesterday during this huge move, all of my calls were in the red. Had I wanted to close out my calls, it would have cost me over $1,000. And then today, because we have a minor correction and we're almost canceling out a majority of yesterday's gains, everything is neutral or green again. And this is one of the scary things about doing strategies with unlimited risk. Had Tesla kept going at the rate it was going, by the time I reached the expiration date of a lot of these calls, I would be liable to sell my shares away at all the different strike prices because, again, growing at the rate it was growing, it would have eventually hit the 600 call by November 20th. Ideally, for a covered call, you're not completely bearish. You're definitely more neutral positive because you are holding the shares, so you don't want it to go down in the long term, and I don't think it'll go down in the long term. Just a couple of weeks ago, the volatility was so high that I was able to sell the calls when it swung high and sell the puts when it swung low. And on average, I was able to close out a lot of my positions all within a week, under a week. Recently, because it's only gone up, I could close some of my put positions. My call positions, I have not been able to close. There are a bunch that have been outstanding for more than a week, and that's not what I'm used to, but actually that is more typical. So one adjustment that I did make when Tesla calls kept climbing higher was that if you look at this column right here, this is about when I'm taking profit or how much profit I'm taking. This column has the total premium I received when I sold the calls or the puts. This is how much I bought it back for, and then this is the net profit. You can see that I'm taking profit at 50% because it's not worth the risk to wait for more and more profit, because the longer you wait, the stock could move against you. This is the adjustment I made right here. I took profit in the 30 something percentage points because this was one of the days where it started to swing a little bit low again. And instead of having 4 or 5 positions outstanding on the covered call end, I might just do 3 or 4 because my end goal is just to make as much premium as I can. I don't actually want to get my Tesla calls called away. So by adjusting when I'm taking profit, I will protect myself a little bit more from these bigger swings. And I'm not going to wait for 50% for my call sections. I'm actually going to wait for a 30%. I'll take profit. I'll wait for a position to reach 40%, I'll take profit. And then for the last 2 or 3 positions, I can still wait till 50%. But I want to take profit earlier now because I don't want Tesla to shoot up and call away a bunch of my stocks all at once. And being less greedy is what's going to protect me. On the put side, I can be slightly more aggressive because my prediction for the Tesla stock for the remaining of this year is fairly bullish. And this is a directional play because I can choose my strike price for my puts. So earlier on, my strike prices were all under $300, but now I'm definitely ticking it up to 328 to 325. In order for the stock to hit this, it would need to have more than a 30% move, which I don't think is likely, but it's still possible. So I'm still putting these positions at deltas under 10. And what these deltas mean is if 8, that means there's an 8% chance that I won't make money on this play. And that's as safe as I can make it while still making a decent amount of premium. But yeah, that's it for this video. It's interesting that when you're an owner of a stock, you only are excited if a stock moves up. Generally, you don't want it to dip. But as an options player, sometimes you want it to come back down hard. If it goes up too fast, depending on your position, it's not good for you. Sometimes you just want it to stay the same. And that's the beauty of options. It's that you can make money on all directions, but that also means you can lose money on all directions. So you have to be very careful. Anyways, if that was helpful, please like and subscribe. Let me know if you have any questions about anything I'm saying. This is Green Knight Trading, where Squires become knights. Thank you all so much for watching, and I will see you soon.